Social Security is one of the most important government programs in the United States, providing financial assistance to retirees, disabled individuals, and survivors of deceased workers. However, many Americans may not fully understand how Social Security is funded or how it affects their own financial future. In this video, we'll explore the top 10 ways Social Security is funded and what that means for you as a taxpayer and beneficiary. 1. Payroll taxes, FICA. The primary source of funding for Social Security comes from payroll taxes, commonly known as FICA, Federal Insurance Contributions Act, taxes. These taxes are automatically withheld from your paycheck by your employer. Both employees and employers contribute 6.2% each, up to a certain income limit. Self-employed individuals pay the full 12.4% themselves. These contributions are deposited into the Social Security Trust Fund, which is then used to pay benefits to current recipients. 2. Social Security Trust Fund. The Social Security Trust Fund is a critical account used to hold and manage the payroll taxes collected from workers. It is divided into two main parts: the Old Age and Survivors Insurance, OAC, Trust Fund, and the Disability Insurance, D, Trust Fund. These funds are invested in U.S. Treasury bonds, which earn interest, and are used to cover Social Security benefits when payroll tax revenue is insufficient to meet the program's needs. 3. Income taxes on Social Security benefits. While Social Security benefits are generally not taxable for most people, certain higher-income individuals may pay income taxes on a portion of their benefits. This includes people who have combined income above specific thresholds. The taxes collected on Social Security benefits are another source of funding for the program. The higher your income, the more likely it is that part of your benefits will be taxed. 4. Interest earnings on trust fund investments. The Social Security Trust Fund is invested in special U.S. Treasury bonds, which earn interest over time. This interest income is a key component of the program's funding. As the trust fund grows through interest earnings, it helps ensure that Social Security can continue paying benefits even when current payroll taxes are not sufficient to cover all expenses. 5. Federal budget transfers. In certain situations, when Social Security's expenses exceed its income from payroll taxes and other sources, the U.S. Treasury may make transfers from the general federal budget to cover the shortfall. These transfers are often made from federal revenue, which comes from income taxes, corporate taxes, and other forms of government revenue. However, such transfers are not a sustainable long-term solution, and they are often used to bridge temporary gaps. 6. Employer contributions. Employers contribute to Social Security by matching the 6.2% of an employee's wages that are deducted from their paycheck. This means that for every dollar an employee contributes to Social Security, their employer matches it, essentially doubling the amount going into the system. This contribution is essential for maintaining the program's financial health and ensuring that benefits can be paid out to current recipients. 7. Self-employment contributions. Self-employed individuals contribute to Social Security in a different way. They are responsible for paying both the employee and employer portions of the payroll tax, which is a total of 12.4%. This is paid through the self-employment tax, which is filed annually with the individual's income tax return. These contributions are critical for ensuring that self-employed workers are covered by Social Security, just like those with traditional employment. 8. U.S. Treasury bonds. As mentioned earlier, the Social Security Trust Fund invests its surplus revenue in U.S. Treasury bonds. These bonds are backed by the full faith and credit of the U.S. government and serve as a secure investment. The income generated from these bonds helps to ensure that Social Security benefits are paid out even in times when payroll taxes alone are not sufficient. The sale of Treasury bonds to the public and other government entities also plays a role in the overall funding of the program. 9. Changes in payroll tax rate or wage base. Occasionally, the Social Security payroll tax rate or the wage base on which Social Security taxes are assessed can be adjusted. The wage base refers to the maximum income that is subject to Social Security taxes, which is adjusted each year for inflation. By increasing the wage base or adjusting the tax rate, the government can increase revenue for Social Security, ensuring that the program remains financially stable in the face of growing demands from an aging population. 10. Federal Reserve and economic growth. The health of the overall U.S. economy can impact the funding of Social Security. When the economy is strong, payroll tax revenues tend to increase as more people are employed and wages rise. Additionally, a growing economy can lead to higher tax revenues, which, in turn, can reduce the need for general federal budget transfers to Social Security. Conversely, during times of economic downturns, revenue may decline, and Social Security might face financial stress. Social Security is a critical part of the financial safety net for millions of Americans, and understanding how it is funded is key to appreciating its sustainability. The program is primarily funded through payroll taxes, but it also relies on interest income from investments, federal budget transfers, and occasional adjustments to tax rates and wage bases. While the program faces long-term financial challenges due to demographic shifts, its funding mechanisms play a vital role in ensuring that Social Security benefits can continue to provide financial support to retirees, disabled individuals, and survivors of deceased workers. As you plan for your future, understanding how Social Security is funded and how it works can help you make better decisions about retirement and overall financial planning.